Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. Today we're going to take a look at my IRA ETF portfolio. I haven't done an update on this one in 6 months or so. Frankly, it doesn't grow that fast because I can only put in a certain percentage of money in my SEP IRA. It's based on a percentage of profits I make from my small business. But I have made some additions recently heading into the end of the year and kicking off 2021. So we'll jump into my SEP IRA, which is filled with nothing but ETFs, and we'll see how my ETF portfolio is doing. Reminder as always that my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your own research before investing. And as always, if you enjoy stock market analysis and videos like this, please give the video a like, subscribe to the channel. Thank you to everybody for your support. All right, let's jump in. So as of today, we're at $56,500 or $471 with the latest update as the market is moving down a little bit here on Friday. And bottom line, this is a all ETF portfolio. I'll show you the holdings here in a second. This is an all ETF portfolio that I hold over at Fidelity. It is IRA, so it is a pre-tax portfolio. And in addition to this $56,000, there's also about $4,700 of a strange bond product that I inherited when somebody else was managing this portfolio, an investment firm. And I took all of the IRAs and retirement money and decided to manage it myself. So we don't have an extensive history here within Yahoo, but I think I loaded this all up around July, somewhere in there. So we've got a good several months to look at. And I set this chart up. This is a 1-year chart. And this is what's kind of cool about Yahoo, because they let you do these like timeline comparisons, and you can add anyone else that you want to in there. And I'm going to add QQQ because it is one of my favorites. And if we go on, this is year to date. Let's make sure we're on 1 year. My portfolio is in blue. This is S&P 500 and QQQ. So the blue lines come in at 1789. The S&P 500 over the past, since July, is up 20%. I'm up less than 18%. And QQQ is up 16%. Obviously, it's a little different story today. If you would have looked in December, or this is even just February, I would have been rolling right along, beating everybody. But now that we've had this market shakeup, things look a little bit different. All right, so this is the holdings view, and I have sorted it by market value. And you can see here that the top three, QQQ, FDN, ARK, then we've got IYC, VYM, VNQ, and XLY. And honestly, I don't think I'll make too many changes to this portfolio in terms of ticker symbols. If anything, I would probably consolidate, maybe just take out one or two and stick with the core names that I already have. I'm definitely not shopping for any new names in here. And my goal with this is to really focus on strong growth because I have many years, a decade at least, if not multiple decades, to let this grow. So I am banking on technology, growth, and consumer. And I've got a couple hedges in here against that should help in the long term as well. All right, let's start with biggest to smallest, Invesco QQQ. This is the top 100 market cap weighted stocks in the NASDAQ. And you look at the top 10 holdings, which is 51% of assets: Apple, Microsoft, Amazon, Tesla, Alphabet, Facebook, Alphabet, Nvidia, PayPal, and Intel. So even though I have very little interest in owning Tesla as a standalone stock, I always mention that it is part of my IRA and an investing strategy as a whole. So this ends up being one of a couple ETFs that does give me Tesla exposure. And of course, if some other EV company in NASDAQ were to suddenly gain ground from a market cap perspective, then they would eventually make their way into the QQQ. There's probably some in there already because this is only 10 holdings out of the top 100. All right, next up is First Dow Jones Internet Index Fund, FDN. And this is another favorite of mine because it really covers the internet stocks, which also includes e-commerce. And that's an area that I'm very familiar with and I'm also very bullish on for the long-term future. As we scroll down top 10 holdings, there is some duplication here. Amazon, Facebook, PayPal, Netflix, Alphabet, Salesforce, Cisco, Twitter, Snap. And for this one, I'm just going to show you just the laundry list of internet names outside of the top 10. So you've got Workday, Snap, Pinterest, DocuSign, Match Group, Etsy, Expedia, VeriSign. A lot of great internet companies in here. I really like this ETF and it'll be part of my investment strategy for many, many years. All right, next on the board is ARK, ARKK. This one, I think everyone knows what ARK is at this point. I've actually been in ARK funds for a little while. The ARKK is relatively new to me. I used to do ARK Web back in the day, but I felt that they weren't holding as true to the internet stock portion of ARKW that they sort of advertise because Tesla made its way in there. So I decided to back out of that and go with FDN, which is much more focused on actual internet-based companies. But top 10 holdings for ARK, we probably all know these: Tesla, Roku, Square, Teladoc, Baidu, Spotify, Zillow, CRISPR, Zoom, and Shopify. All right, next on the board is another favorite of mine that I recommend, particularly in this economic rebound opportunity, IYC, U.S. Consumer Services. This is all about United States consumers spending money. So you've got Amazon, Disney, Comcast, Home Depot, Netflix, Walmart, McDonald's, Costco, Starbucks, and Lowe's. So if you believe, whether through stimulus, going back to work, tax refunds, whatever your take is, that you believe consumers are going to spend a lot of money in the year 2021 and beyond, this is exactly where you want to be. IYC is a great ETF. All right, next up, VYM, Vanguard High Dividend Yield Index Fund. This is the dividend play of my ETF portfolio. And while I do think QQQ and even ARK offer some dividends at the end of the year, this one's really focused on companies that produce dividends. And it's another hedge play, if you will. And oddly enough, it'll probably perform pretty well here in the next few months, the way tech's selling off and people are rotating to these types of names: JP Morgan, J&J, Procter, Bank of America, Intel, Comcast, ExxonMobil, Verizon, AT&T, and Chevron. So, you know, at first glance, very unlikely that I would buy any of these companies, maybe Intel as a standalone stock play. But when you're building ETFs, this makes a lot of sense for the long-term kind of retirement portfolio. All right, next up is the real estate portion, Vanguard Real Estate Index Fund, VNQ. And this one just invests in REITs, basically. And one of the reasons that I chose this one out of all the different REITs available and REIT-related ETFs is because it has some of the new age REITs, right? So American Tower is cell phone towers, Digital Realty Trust is data centers, and even public storage, which is, you know, just those orange buildings where you can keep your Christmas tree and stuff in. I really like the way that they put this together in relation to companies and businesses that I'm interested in. So that's why I chose this one. You got Vanguard Real Estate Index, American Tower, Prologis, Crown Castle, Equinix, Digital Realty Trust, Simon Property, Public Storage, SBA Communications, and Welltower. All right, finally, the smallest holding is this XLY, which is Consumer Discretionary Select. It's a spider fund. And, there was a time when I bought a couple shares of these because the expense fee was less than IYC. But as time went on, one of the things in their top 10 holdings and all their holdings for that matter that really started to bug me was that it didn't have Disney in it. And I don't know why, I just couldn't get past the fact that Disney, I think it's also missing Netflix, were not part of the equation for things that they selected. You also see that their top 10 holdings at 70 some percent, that's pretty compartmentalized in a lot of ways. So I'm not selling this, but it would be the first one I sold. More than likely, though, I'll hang on to it. Certainly, at least through this potential consumer boom period that we're about to head into. I like these names: Amazon, Tesla, Home Depot, McDonald's. Some of them are duplicates. Booking Holdings, it's nice to get that in there. TJX I hold as an individual stock. But bottom line, I think for me anyway, I like IYC better, even though the expense fee is slightly higher. All right, landing back on the main holdings screen, the way that I'm setting this up and the way I buy into this is really having these top three represent 60%. So, very close to 20, 20, and 20% for these top three. QQQ is always going to probably be in the 22, 23% just because I do like it the best. And then these ones over here below that threshold, you're going to be in like the 10% on consumer, 10% on dividend, 10% real estate, and then another 10% on basically consumer for the XLY. So I'll be adding at that pace to preserve those percentages best I can based on prices. And then if I ever sold out, I would probably sell XLY and just move everybody's percentage up a notch or two, reinvest into those areas. At the end of the day, for me personally, as an investor, I want technology, I want internet, and I want consumer spending to be the focal points of this portfolio. Then the hedges from there are going to be my dividend and my real estate combined coming in at about 20%. If all of the, let's say tech falls, right? So tech falls is definitely dragging the Qs, FDN, and ARK down, no question about it. But those are the pillars of growth for the long-term future. IYC would likely go up in this current environment as earnings come in from consumer-based businesses. And then the dividend stocks and probably real estate too. These three as a core in 2021, if the tech meltdown continues, these three are probably going to sort of over-index and grow while these will falter some. It's okay. I actually don't care if this goes down a little bit or if the whole IRA takes a hit this year, if tech really does melt down, because at the end of the day, this is, multitudes of 10 plus years. So the point here is just to pick the investment theme that I like and invest in it. All right, guys, so that's a look at my ETF portfolio that I keep in my IRA. Hopefully it was interesting for you to look at. One call out that might be sort of obvious to some people, no S&P 500 in there. Rationale for that, I just don't believe the S&P 500 is worth the time of investing over the long term. If you're managing your own investments, I don't think you need to go to S&P 500. I think it's too diluted when the majority of folks would probably say that the growth index for the United States is probably going to fall well within the other more thematic ETFs that I chose. And then also, you probably noticed that the total stock market index fund, whatever that is, the international one, again, just not something that does a lot for me, to be honest with you, as far as getting excited. Plenty of people went on that strategy, and I'm definitely taking on more risk, but that's okay. I'm comfortable with it, and I've chosen everything in my ETF portfolio for a particular reason. But obviously there'll be plenty of folks who disagree and think S&P 500 and total stock market is like, the way to go for them. Nothing wrong with that. Everybody gets to pick their own flavor in this game. All right, guys, if you enjoyed this video, please give me a like and subscribe. We'll see you on the next video.